Chart patterns. When you are trading on Forex, you have one main goal: to spot major fluctuations in currency exchange rates before they occur. If you can do this, you can make a lot of money. In order to have the ability to spot these movements, you need to be able to read chart patterns. These patterns will help you predict when the market is about to break out and when it's about to reverse direction, so you can take advantage of those fluctuations. There are 6 basic chart patterns that you need to be familiar with. There are, of course, variations on all of these patterns, but when you know these 6, you can make solid movement predictions. Doubles. There are 2 types of doubles patterns you will need to recognize. First is the double top. This is a pattern that is created when there is an extended upward move. The tops are the peaks that form when the price reaches a level that can't break. Once the price hits that level, it will bounce downward slightly, but then bump right back up. If it bounces downward and back up again, you'll get a double top. The second top is not as high as the first top. A double top is a strong indication that a reversal is about to happen because the buying pressure is almost over. You will want to look for double tops after a strong uptrend. The other type of doubles pattern you want to know is the double bottom. This is the exact opposite of the double top. You are looking for a double bottom after a strong downtrend. The price forms 2 valleys because it can't go below a specific level. The second bottom won't be as low as the first bottom, an indication that the selling pressure is almost over and the price is going to move upward. Head and shoulders. This is another type of trend reversal pattern that is formed by a short peak, shoulder, followed by a higher peak, head, followed by another short peak, shoulder. You can draw a line between the lowest 2 points that is referred to as the neckline. A downward slope of the neckline is a reliable indication that a reversal is about to occur. You would want to put in an order entry that falls just below the neckline to take advantage of the price before it drops. There are also inverse head and shoulder patterns that are the exact opposite of the above pattern description. In this case, you would place an entry order above the neckline to take advantage of the price before it rises. Wedges. There are 2 types of wedges that indicate a pause in a current trend. This pattern tells you that traders aren't sure where to move the currency pair next. You might see the trend reverse or continue after a wedge pattern. The first type of wedge pattern is called a rising wedge. This is when the price consolidates between support and resistance lines that are moving upward. The support line is steeper than the resistance line, which signals that the higher lows are forming more quickly than the higher highs. This movement indicates that a breakout is about to occur. Essentially, a rising wedge that is formed following an upward trend typically leads to a downtrend. A rising wedge that is formed during a downtrend usually leads to a continued downtrend. The second type of wedge pattern is a falling wedge. This can also be a signal of reversal or continuation. If it forms after a downtrend, it will typically lead to an uptrend, but if it forms during an uptrend, it will usually lead to a continuation. Rectangles. Rectangle patterns are formed when a price has parallel support and resistance levels. This is a time when there could be a price consolidation or buyer and seller indecision. The rectangle is formed because the price is testing support and resistance levels over and over again before breaking out. At the point of the breakout, the price will likely trend in whichever direction the breakout occurs. A bearish rectangle is created when a price consolidates during a downtrend. Typically, the price will move even lower. A bullish rectangle is created when a price consolidates during an uptrend. This is a sign that the price will move even higher. Pennants. Pennant patterns are continuation patterns that are formed following strong movements. After either a strong upward or downward move, buyers or sellers allow the price to consolidate before taking the currency pair in the same direction. When this occurs, it creates a symmetrical triangle that is referred to as a pennant. During the consolidation period, more buyers or sellers, depending on the direction, get in on the action and force the price to continue in the same direction. A bearish pennant forms when there is a steep downtrend in price, whereas a bullish pennant forms when there is a steep uptrend in price. Triangles. 3 different triangle patterns can form when trading on Forex. The first, a symmetrical triangle, forms when the slope of the highs and the slope of the lows meet together at a point. This means that the market is creating lower highs and higher lows over a period of time. It also indicates a kind of price consolidation. As the highs and lows get closer together, you can predict that a breakout is imminent. However, you don't know which direction that breakout will go. Eventually, either buyers or sellers will get their way. To take advantage of a symmetrical triangle, you will want to place an entry order above the slope of the highs and below the slope of the lows. This will allow you to profit no matter which way the breakout occurs. An ascending triangle forms when a slope of higher lows and a resistance level meet together at a point. This pattern indicates that buyers aren't willing to take a price above a certain point, but they are gradually pushing the price upward. They are pressuring the resistance level, which indicates a breakout is likely to occur soon. In most cases, an ascending triangle indicates that the price will move up past the resistance level, although this is not always the case. A descending triangle is just the opposite pattern of an ascending triangle. There is a slope of lows and a support level that meet together at a point. This indicates that there is a price that sellers are unwilling to break, but the price is gradually being pushed downward. Most of the time, the price will eventually break out and continue to move down. Keep in mind though that this is not always the case, and it can sometimes bounce off the support line and move upward. Again, it doesn't matter to you which direction it's going to go, because you simply place an entry order above the highs and below the support line and take advantage when it moves. You cancel the other order and profit from the fluctuation.